Hello, and it's good day once again to all of the entrepreneurs out there. And I wish that this presentation from UNIDO ADIP of Bahrain will encourage you more to develop your business, to grow your business, and be more inspired as an entrepreneur. Today we are going to present to you about financing on your business growth. In this presentation, you will know the following contents, which is: first, we discuss to you the introduction. Second, we talk about the debt financing. Third, we will be discussing to you the equity financing. And of course, we would like to compare what is debt versus equity. And finally, the source of financing. To start with, in order to expand the business, it is necessary for owners to tap financial resources, in which a variety of financing institutions provides, which is example from the different resources if you want to take your loan, and these are cut into two categories. It's either you will do in debt or you will do an equity, meaning a debt financing and an equity financing. First, we should know what is a debt. Taking loan, you consider this as a debt. So this involves money but should be paid back plus an interest. Take note, an entrepreneur will always incur loan, will always to have a debt in order to grow. It is very ideal if your business, you don't go for loans, you don't go for borrowings. So you need to borrow your money if you're going to grow. If it is not needed, then it would be ideal. But if you need additional amount of capital, you need to have a debt financing. This involves borrowing money, but take note, it should be paid back. It should be paid back. The principal should be given back, and of course, plus the interest. So when to acquire a debt or a loan or borrowings, it needs a guarantee. It is a must for us to know as entrepreneurs that when we borrow money, we need to pay it back. And when we need to borrow money, we need to have a guarantee. We need to have a collateral, something that will secure your investors or somebody that's going to lend you or your creditor, that you are going to pay back the money. And if worst comes to worst, there is a guarantee. So, especially for a smaller business, personal guarantee are likely to be required. But note down, it is not only for personal business or personal borrowings, but also for commercial borrowings. If you use it for your finance and you went into a financing institution, you call this a commercial debt financing. They also require a guarantee. A guarantee can be part of your asset, which is maybe your car, your real property, some of your investment that you have can serve as your guarantee. The next is, what is equity? First, we need to know what is equity, and later on we will know what is equity financing. Equity involves raising money by selling your ownership in the company. The first one is borrowing from outside. This one is you are going to sell your parts of your ownership in your company. This is what we call an equity financing. So what is equity? This is a form of financing that allows the owner to obtain funds without incurring debt, without having to repay a specific amount of money at any particular time. Why? Because it is part of your business. It's part of your ownership. So it is called as an equity financing. The next is debt financing. What is a debt financing? When a firm raises money for working capital or a capital expenditure by selling bonds, bills, or notes to individual or to any investors. I get this definition. Reference is from investopedia.com, meaning that when we are doing a debt financing, our firm raises money for working capital. We know what working capital is. Or for our capital expenditure by selling bonds. Bonds is called a security for indebtedness. It is a certificate of indebtedness. When you sell a bond, you issue a bond, meaning you are issuing a certificate that you are indebted to your creditor. And bills, if you have to take your notes and bills, you're going to write your promissory notes for the individual and to the institutional investors. This is what we call as debt financing. There are lots of commitments when we incur debt. What are they? First, as I have mentioned to you, we need to have a collateral. So a collateral asset must usually be available. We cannot just borrow money and we don't have any assets that serve as a guarantee, that serve as a collateral. So a collateral must be there. Second, it must be paid back. Or when you have borrowed the money, when you incur loans, you need to pay it back or you need to refinance. Refinance is that when we tap other financing institution to finance our debt or to restructure our debt. Important thing is that we as debtor, we have a commitment, a serious commitment that when we borrow money, we need to have it in mind. We are responsible to pay it back. We have a collateral, and that if we don't have the capacity to pay it back, we can have somebody to refinance it or another institution to refinance it. Okay? The third one, we must have a regular payment of interest. We should know, we must be knowledgeable as debtor. The one who is borrowing must know that there should always be an interest that should be included in your payment. And thus, this must be paid regularly. Some of the borrowers, they pay only the interest and eventually add the capital of your loans. Other calculations, it includes both the capital and the interest. Others, you can pay back the principal in the end of your agreement, but eventually paying your interest monthly or regularly, whatever being discussed or included in your contract. The fourth one is a company must generate cash flow to pay. Yes, if we decided to borrow money for growth of our business, we make it a point that our business must earn. We have to make it a point, we have to manage that our business is still functioning, earning an income, it's there existing. Because we must generate cash. We must generate revenue in order to pay our obligation when we borrow money. So take note, this is a commitment. Let us abolish in our mind that when we borrow money, we forget it. No, when we borrow money, we need to have a commitment. We need to have a responsibility to pay it back. Okay? Next is the most important thing is, what are the most important informations in obtaining a loan or a debt? When we raise a debt capital, it is less complicated. Yes, debt financing is less complicated than equity financing, because the company is not required to comply with the state or in your government or any federal securities or any laws and regulations. Why? Because debt financing or loan is when you sell your ownership, part of your ownership. Second important information about obtaining loan is that debt providers are conservative because they cannot share from any income or profit from your company. So they are very conservative. They are really focused on what was agreed upon. Therefore, you need to pay them back. They want to eliminate all possible loss or downside of your any risk. So in other words, they're very careful. They monitor you. They would see to it that your business is working well, because they cannot afford to see you downsizing. They cannot afford to see you losing. That is why we say that they are conservative, because if possible, refinancing is not, if possible, acceptable, because that will also destroy your credit standing to them. Third is another information for obtaining loan. Debt providers have little or no impact or control of your company. This is the reason why they are very conservative, because they don't know what's going on inside your business. They are not particular on how do you manage your business. They are there only to give you your loan. Okay? And the fourth one, the lenders are entitled only to be repaid. Once you pay them, it is not their obligation to train you or to give you marketing or to give you clients. They are only entitled to be repaid of the agreed upon principal of the loan plus the interest. Hence, I would like to note down that, look at this, they have no direct claim on future profit of your business. So in other words, they are not part of your business management. They are not part of your operation, and they are not even owners. So you need to pay them back. That is the most important thing. Another is, except in the case of variable rate loans, principal and interest obligation are known amounts which can be forecasted and planned for. What do we mean by this? It depends of your agreement if the loan that you obtain is fixed or not. So if it is fixed, then the variable rate loans will not matter at all, but you need to follow the fixed rate. But if there are variable rate loans, then you must know it, because in every period there are changes of interest rates, and you must be aware of that. And that the amounts you must be aware also, so that you know how much is being added in your payment, to your payment, and also for your interest. But once you are doing this agreement, they can be forecasted. Banks have their formula in forecasting, and it must be planned as well. So you are given already the plan for your payment. So always ask for the plan of your payment, so you will know how much each month you're going to pay in 3 years, in 4 years, or in 5 years. Okay. The another information that you need to know in obtaining loan is that the lending company is not required to send periodic mailings, not to remind you all the time. You must know it. Okay, that's why sometimes banks or lending institutions, they require you to issue checks. So at the end of the month or any date issued by you in your checks, they will deposit it, and eventually once you did not comply, there will be a corresponding charges for the bank if you did not your check is overdraft. But here they will not give you a periodic or a regular calls or a periodic mailings, as what he said, to a large number, especially for large number of investors. Another is they do not hold periodic meetings with you, okay, or seek the vote from you, or even before taking into action. Once you have done the agreement, you get the proceeds of your loan, the contract is there, dates are included, amounts are being specified, you know your obligation. So those are important in obtaining debt or a loan. The next topic that we are going to discuss is about the equity financing. What is equity financing? This is a process of raising capital through the state of shares in an enterprise. It is essentially refers to the sale of an ownership interest to raise funds for business purpose. That's what I discussed with you. When you say equity, you are selling your part of your ownership. So what are the commitments then? Will it be the same as the commitment when you do the debt financing? What is the difference of the commitments if you are obtaining equity financing from debt financing? Here are the commitments on equity financing. First, we have equity represents ownership. That's why it is an investment, hence no repayment is expected. Owners may receive dividends, but only after keeping the retained earnings. So that is a commitment, that you don't expect anything to come back to you when you are having your equity financing. Meeting the financial requirements of the business. This is another commitment, which is the same in the debt financing. Business owners are responsible for the investors. Okay. If it's equity financing, as what we said, to give you, it's a process of raising capital through the sale of shares. So in other words, the owners may receive dividends, and the business owners are responsible for the investors. In other words, there's additional people being part of your business, but they are not owners. They are only investors. What are the important information on equity financing? First, there is no collateral required. It was not like debt financing, you need to have a collateral because there is an external stakeholders that is involved. But here now, they are there. They are external, but they are part of your ownership. You are just selling part of your ownership, but it has to be clarified if they are part owners or they're only investor. The second is they can usually be kept permanently. In other words, the investors, the ones who bought your part of ownership, they can be there permanently. Unless otherwise, you change your articles of corporation or articles of partnership that you include additional partners. That will be another story. But if they're only an investor and they just bought part of your shares, they can be permanently involved in your business, but they are not a part owner. Another important information, which is the last topic that we discussed for today, equity requires shared control of the company and may impose restrictions. So since there are other people involved in your ownership, there should be a shared control. There should be a proper monitoring of your company function, company operations, and it can also impose restrictions. It is very important also that you have to impose restrictions for your investors, because eventually you may not notice that they're already part of your business ownership. And that ends our presentation for this. Then that will be a part 1, and part 2 will be discussing about importance of financing. Thank you.